And so it's really, really important that you protect yourself from falling prey to these sales tactics, because what happened is these companies basically made a deal with the devil, and they said, hey, we're gonna go out there, we're gonna do this, we know it's gonna get sales, but the bottom line is it's worked and it's been okay, even in this reducing cap rate environment that we've had, where caps have gone down almost over 33%, right? In that environment where that has been happening, policies have still performed well. Why? Because we've had great performance. We've had success, but you got to think about, and the markets have done really well, but you have to think about the fact that when cap rates go down, when you first had your illustration and it looked really good after all the costs and fees and everything, if you have a down year, it's like, okay, if the market came back and you got a 15% cap rate, that means when the market came back and made a recovery, you would get that 15%. Now you're only able to realize 10% if you got a 10% cap rate. And as they go down, some of these cap rates are down in the 8% range, and they're getting lower and lower and lower. So how can you be expected to make up for it when your cap rate is 6% or 7% or 8%, which is where a lot of these things are going. And it's pretty disgusting when you really look at it. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, I want to talk to you about the 7 reasons IULs are dangerous right now. I know IULs are the most common and most popular sold life insurance vehicle on, I think, the continent right now. I know that with all the social media stuff, with the TikTok, with the YouTube and Instagram, there's a lot of people selling Index Universal Life as this great alternative for retirement income. Now, I know I've got a lot of content out on this, and I know that I always say that there's a place for it and that it works. What I want to go through today is going through the 7 reasons I think IULs are dangerous. I think in the middle of this conversation that I have with you today, I'm going to kind of try to focus on not only what's bad, but maybe where some of the things actually work, right? Like, maybe where if you didn't missell or misrepresent what Index Universal Life was actually designed to do, the problems that it could be able to solve for you. And so in the midst of all this, as somebody who's selling it or somebody who's looking to buy Index Universal Life, what I encourage you to do is really, really think about what I am saying here, because what I know to be true is most people who are selling Index Universal Life just don't know what they don't know. They're only taught what they're taught by their upline in the MLM that they're selling it with, or they're only taught but what they know by the wholesaler for the company that's just out there trying to sell a product. So I'm looking to bring new information to the table right now, taking my past experience, my past, I guess, time with a Fortune 1000 company as the director of business development with them, to take the training and everything that I got in my conversations with the actuaries and the people that design these products and bring it to the forefront for you. All right, so without further ado, let's just get into this. So option number 1, or reason number 1, I guess, is that Index Universal Life is dangerous, is that cap rates can be lowered. I'm going to get into more about this, why, but the bottom line is they're run with an illustration. When I first got into the business in 2009, and 2009 through 11, cap rates were between 15 and 16.5%. Now, we've had the greatest bull run in the history of the stock market from that point in time, from 2009 till today in 2022. Yet somehow during that period of time, cap rates have still been reduced. Now, I'm going to get into why later in the video, but the bottom line is, if you look at the contract and you really evaluate it, they've proven history is the predictor of the future, right? Like, we can look back and see what they've done. Now, it's important to understand that this isn't just about Index Universal Life. This is about what insurance companies that sell Index Universal Life, what the insurance industry also did with the traditional Universal Life market before it, right? Like, if you understand the history of IUL, it's really the second iteration of a Universal Life contract, which was created originally in the early 1980s. And what insurance companies did then is they had a good 15 or so years, maybe 15, 20 years of performance of Universal Life. But what happened was, as that cycle ran out, as surrender cycles ended, and as the market shifted and the environment changed, the insurance companies did what they had to do to survive and to remain profitable. And what happened there is the people who were actually holding the Universal Life contracts basically took a bath. They took it on the chin and they lost a lot of money, and a lot of policies lapsed. A lot of people had to write big checks if they wanted to keep their policies enforced, and it was a real ugly scenario. Now, if you understand how Index Universal Life works, then you know that they're not very old. They're less than 25 years old as a product, but really Index Universal Life didn't hit its full stride as far as popularity goes until after the Great Recession. It was 2009, 2010 when they became really popular. 2009, Pac Life became the #1 IUL company in the country, and at that point in time, IUL sales started to soar. More and more companies got into the market. In 2011, there were about 14 companies offering IULs, and now there are almost 50 companies. And so now, back then, there were millions of dollars of options being traded. Now there's billions and billions of dollars of options being traded. And so they've created their own monster. Now, cap rates, and I'm going to get into why and all that stuff later, but this is why cap rates have to come down. And if we look at, history being an indicator of the future, what they did with Universal Life is ultimately going to show you how they're going to react with IULs. And the fact that they've reduced cap rates in this booming, strong market environment from 16% down to about an average of 9.5% or 10% right now, that it's pretty ugly. And we're going to get more into this. But reason number one, that's my long way of saying reason number one that IULs are dangerous is because they can reduce cap rates. And those cap rates, look at the contract, look at the fine print. The insurance company has the contractual ability to reduce your cap rates to between 3 and 4% for most carriers. So reason number two that Index Universal Life is dangerous is that participation rates and cash blends can be reduced to change to the benefit of the insurance company and hurt the policyholder. This is very similar to cap rates, but we're talking about participation rates and cash blends inside of the no cap products. That's a big deal to think about, because what happened was AG 49 came out. Just to give you a little context, 2009, which is what I was just saying when these became popular. They became popular because these insurance companies started creating what we would call illustration wars, where they had these high unrealistic expectations of illustrated rates. And then what happened is AG 49 came out. It was a regulation that basically put a governor on how much they could illustrate these rates for. But what happened was these companies came out and they created all these different rules and multipliers and things that would help them illustrate higher returns. Now, it took more risk. It created more risk inside of the policies, but it allowed them to illustrate at a higher level. And so it kind of got away from the foundations and the principle that these IULs were created for at the beginning to begin with, right? And so what's happening here is that by creating these no cap indexes and strategies, they in order to do so, they have to have a participation rate that goes to it, and you have to understand the cash blends that they utilize inside these to be able to get the performance. And in that, it's important to know that even though there might not be a cap rate, it might be an uncapped index that you're participating in, they still have the ability to change and manipulate your participation rate and manipulate the cash blends that are utilized in there. Now, this is one of those areas that they've gotten really out of control with, and it's overly illustrated in a way that shows performance that is way too high, that is unrealistic, and regulators know this. They've seen the class action lawsuits that have come from it, and so what they're doing is they're updated, because listen, regulators are trying to keep up with all of the insurance companies that keep changing to get ahead of their rules. They created AG 49, and companies created multipliers and proprietary indexes, and then they came out with 49A, and they keep coming up with all these different changes, in the way that they're able to illustrate. And so now they're going to be coming up with AG 49B, and I can't wait till that comes out, because that is going to put a fix on a lot of the dangerous illustration tactics that are happening. And so that actually gets me to reason number 3 that IULs are dangerous, and that is the proprietary funds. Now, utilizing proprietary indexes, I guess is the way. It's not just a fund, it's a proprietary index. They're misleading, because what they do is they create like an inflated illustrated rate once again, because they make these indexes to be able to back test and show this back test of success of a higher rate because they were to be able to cherry pick the investments that look really good in the fund. Once again, AG49B that's going to be coming out is going to be dealing with this issue as well. So you're going to see a day of reckoning for all these companies that have been utilizing the no cap products, the proprietary index products. They've all been utilizing illustration tactics that are not in the spirit of what the original regulations were speaking to. And so it's really, really important that you protect yourself from falling prey to these sales tactics, because what happened is these companies basically made a deal with the devil, and they said, hey, we're going to go out there, we're going to do this, we know it's going to get sales. But the bottom line is it's worked and it's been okay, even in this reducing cap rate environment that we've had, where caps have gone down almost over 33%, right? In that environment where that has been happening, policies have still performed well. Why? Because we've had great performance. We've had success, but you got to think about, and the markets have done really well, but you have to think about the fact that when cap rates go down, when you first had your illustration and it looked really good after all the costs and fees and everything, if you have a down year, it's like, okay, if the market came back and you got a 15% cap rate, that means when the market came back and made a recovery, you would get that 15%. Now you're only able to realize 10% if you got a 10% cap rate. And as they go down, some of these cap rates are down in the 8% range, and they're getting lower and lower and lower. So how can you be expected to make up for it when your cap rate is 6% or 7% or 8%, which is where a lot of these things are going. And it's pretty disgusting when you really look at it. So that reason number 3, that they're dangerous, is relying on these proprietary indexes. The other thing about the proprietary indexes is, in order to build them to create a little bit of stability, they have a lot of long-term exposure to bonds. That's how they balance them out. And so when you look at a lot of these, those indexes are going to way underperform what the past performance looks like. And so you have to take a look at that and really understand it. Make sure you really do a deep dive before you get involved in any proprietary index. In fact, I would just say be very, very careful and don't get involved in any IUL. If you decide that you want to go an IUL, go with a really, really clean IUL with very, very conservative assumptions. I would always bank it on no better than 4.5% to 5% as far as what the real internal rate of return goes for the policy long term. And I would never get a company, never buy a product that had a proprietary index associated with it. Now, the fourth reason that IULs are dangerous is because they're able to illustrate positive arbitrage of 50 basis points on the illustration, right? Like inside of when you decide to illustrate for loans taken out, because let's face it, they're talking about IULs being this great income alternative. So first and foremost, never get an illustration or sign an illustration or buy a product without seeing the illustration, what it would look like without taking income from it. Because these illustrations have software that basically, if you don't have the income coming out of it, they don't have to put certain disclaimers on it. If you have the income on it, it will put up disclaimers, fine print, that and you have to read every line of it that will tell you, even though it shows a positive arbitrage of 50 basis points, and people that sell this as this kind of golden goose that is amazing, like MPI is an organization that shows you, and they say the RELOC, the retirement equity line of credit, this feature is based on your ability to have positive arbitrage through your policy loans, when in fact, even though they sell that's the best thing in the world because they allow it to be illustrated on the illustrations with a guaranteed 50 basis points of arbitrage, that's where all the risk comes in with the MPI strategy. Because when you read the illustration, you read the fine print, you realize you're signing off, that you realize that you have a lot of risk and that you can lose all your money because of this. Because when you get older and when this thing becomes more mature and you get through the surrender period and you're older and your costs of insurance are higher and you've used the option B, which is the increasing death benefit, and you've got a lot of money into this thing, but now you start taking loans out and you still have this gap and your net amount at risk is still higher, and you have all these loans out, especially using MPI, because you're utilizing loans to get more policies, right? Now, if you have a couple bad years in a row, or you have 3 or 4 bad years out of a 10-year period, those expense those expenses compound against you, right? Now, MPI is the most extreme example of this, but the bottom line is you're looking at this principle works with every single policy loan. I have seen so many policies blow up because of the fact that people don't realize the negative consequences in an IUL when you use the index loan feature, the fact that it's not a wash loan. You have this interest expense that you have to maintain. If you have a negative year, not only do you have the insurance charges, the admin charges, but now you have those loan charges that are compounding. And if you have literally millions of dollars or hundreds of thousands of dollars in loans because you've done this to buy more policies or to get more policies inside of like an MPI kind of system, now what's happened is this compounds against you. And if that happens 1 or 2 or 3 years, in a short window, in like a 5 to 10 year period of time, you are in a lot of trouble. And so you have to make sure that you are protected and insulated from that. And this is another area that AG 49B is looking to address. And when they do this, when this comes out, I'm telling you, all the people out there that are selling based on this illustration war and these values that are giving you assumptions that they're going to give you these returns, those programs are going to get shut down, and you're going to see lawsuit after lawsuit after lawsuit because of the fact that they were so misrepresented. So reason number 5 that IULs are dangerous is because the increase of fees and charges. You know, I just kind of talked about it a little bit in the last point with point number 4, but the bottom line is as you get older, it's basically annual renewable term inside of these index universal life policies. And so it's all based on the net amount at risk, and they're sold on the fact that the net amount at risk should be shrinking over the years. But the bottom line is if you want to jam a lot of money into these, you need to do option B, which increases the death benefit when the cash value goes up. So that net amount at risk stays there. Now you can convert that to an option A when you stop funding the policy, which is, if you're going to do it, that's the way to go. But at the end of the day, as you get older, once again, if you're in your 60s and you start taking income when the insurance is expensive and you have a couple down years, and the insurance company needs to create sources of revenue, they can increase the fees, the admin charges, they can increase a lot of things. There's a lot of different levers that they can pull. But the bottom line is when you have loans against it too, those costs compound. And so what that does is it makes your net amount at risk higher. Those are all expenses. They become internal expenses of the policy, and those can compound against you in a really, really negative way. And it can force you to either have to write a big check to make the policy not lapse. But let's face it, if you were utilizing this for a retirement income alternative, right, like for tax-free retirement, it's putting you in a position where you're probably gonna fail because you're not gonna wanna cut that check just to keep the insurance, because that's not why you bought it in the first place. So reason number 6 is market volatility. Listen, I know that IULs are sold as this massive hedge to market volatility. They're always sold on this upside potential, downside protection. And they're supposed to be a tool that helps you eliminate market volatility. But the bottom line is nothing could be further from the truth, because in down years, you still pay insurance and admin charges, which, so it's not really a zero. You get a negative in that context. And to make it worse, like I said before, if you have policy loans out, these loans compound against you, right? But here's the other thing, and this is going to get me into number 7 here, but with the market volatility, it creates a lot of problems for index universal life policies because of the way that they are funded, because of the way that they participate in the index. Because remember, they never really buy the index. What they're doing is they're leveraging options. And in highly market volatile environments, what happens is the cost of options goes up. And so that brings us to number 7, which is the options market is set to suffer with an increasing interest rate environment. Let's look at this. So what I want to do now is I want to take a couple minutes and I want to show you about what this looks like. Like I said, these proprietary indexes are going to suffer, but options in general are going to become more expensive. And I want to talk to you about how this works right now. So let's take an example of somebody that's got $10,000 in cash value inside of their policy. What happens is the insurance company says, okay, we know we can earn 4% on that money. So that's $400. So that effectively creates what we call an options budget, an OB, which is an options budget. They take this $400 and they go and they buy options, right? So what will happen is this is where you get the upside potential. This $400 buys options. So whatever that can get for a return, let's say that gets you a 10% cap, right? So it would say, okay, if the index did 10% or more, you would get that. But if it lost, you would lose the $400 and your $10,000, you would have the preservation of your capital there, right? So that is the important thing to understand there. Now, why have the indexes, why have the IUL cap rates been reduced over the past decade is because of the fact that options costs have gone up. So even though cap rates were 16.5% a decade ago, right? What's happened is they've had to reduce these cap rates. They've reduced them because of the fact that options prices have gone up, right? These option prices have gone up, so it buys you fewer options. So if you buy fewer options, then you're dealing with this. The cap rate has to come down because they just you can't buy as many options, so the return just obviously isn't going to be as good, right? And so then the other component to this is that this 4% right here back in 2011, that 4% was more like 6.5%, right? So they had more money to buy options with, and options were cheaper, so therefore you could have a higher cap rate. Here's the problem moving forward. We're going into a high interest rate environment, which is going to be better, because what's going to happen is maybe we get a budget that goes up as a whole, like because this general fund 4% that they know they're going to get for a return is 6.5%. The problem is with interest rates going up like that, with the bond markets as they are, especially, and here's the key to understand, especially the companies, the people with IULs inside of proprietary indexes are going to suffer because they have long-term exposure to low interest rate bonds, to the bonds that were in the cheaper markets, right? Because they can't get out. They're more of a long-term thing. That's what they had to do. That's a whole video on its own. If you haven't checked it out, I would say go check out Bobby Samuelson's blog. It's called lifeproductreview.com. He talks about it and breaks it down. It is so complicated with so many graphs, but it is so vital. If you're looking to buy a policy, I would say go get a subscription to Bobby's blog. It's $100 a month, $99 a month. And if you're looking to buy any of this stuff, go check him out before you buy. It's worth a $100 investment before you could put thousands or tens of thousands, if not hundreds of thousands of dollars through your life through a product like this. You have to go do it. That's 100% what I would suggest. So what I'm saying here though is as interest rates are going up, that creates volatility. Volatility creates more expenses in the options market. So while their budget may go up, the options budget may go up here, that may be the case. But the bottom line is because of the volatility, it might be a hedge, and in the sense that there's one force that'll make options cheaper, one force that'll make them more expensive. And in that environment, ultimately, the cost of options is still going to stay historically high like it is today. And that's the biggest factor. That's the biggest factor that comes into play with all of this stuff is the cost of options. If you don't understand options, you should not buy an IUL product. Now, most people think of options as a way to maybe hit a home run, right? You can short the market, you can go long on the market. Shorting an option or shorting the market is one way to do it. A lot of people, especially during the Great Recession, if you ever saw The Big Short, that was a way people made literally billions of dollars, I think, on shorting the market. Now, the way that insurance companies utilize options is really, it's not designed to get massive returns. It's a hedge. Let's just use a little common sense with this, is that if insurance companies right now are having a hard time getting 4%, right? That's what they're doing. And they're utilizing this 4% budget to get this strategy, buy these options to potentially get you 10%. That's how it's sold, right? That's the concept. That's the philosophy behind an IUL. If that's the case and they're using this 4%, that's what they're getting in the general fund. Why wouldn't they take that and do that for themselves if it was so safe to maybe up their level to 6% or 7%? Why wouldn't they do that? It's because it doesn't work that way. The difference is when they have a 10% IUL cap rate right now, they know that they shouldn't have more than a 5 to 5.5% cap rate. That's what they know. They shouldn't have more than a 5.5% cap rate. However, the spread between the current cap rate, which let's say 10 and 5.5, let's call it 4.5%, that spread this is basically written off as a marketing expense for the company. And they know that. And so this is a loss leader to be able to bring in business. And this is when I said earlier, they made a deal with the devil. This is the deal that I'm talking about. They know that this is going on, and they know that people are going to get hurt from this, and they're not going to perform the way that they're illustrated. And that is my biggest problem. Not that IULs are bad. I'm not saying index universal lives are bad, because listen, if you go out and you run an illustration with a 4.5 to 5% IRR, and that's the assumption that you're banking it on, guess what? I'm good with that. You're probably going to be in good position. And is there a chance it could outperform that? Absolutely. But if you go in expecting it, my problem is they always sell them like this 10% and like it's realistic to expect 8%. It's not going to happen. You're not going to get that inside of one of these policies. It is not going to perform the way that they say it's going to perform. There's just too much fighting against it, and you need to understand that. If you think that you're comfortable doing 4.5 to 5%, by all means, get an IUL. God bless you. Good luck. But when it comes to that, for me, that's one of the biggest reasons that I go with whole life insurance every single time. It's one of the reasons I got out of the index universal life game altogether, because I know that if that's the game, and long term, the overriding principle is that the performance of an IUL is never going to be able to outperform the underlying performance of the general fund for the insurance company, then it's a losing game. And so what I would say to you is make sure that you understand all of these moving parts. Make sure that you read every line of the policy, and don't let the insurance salesperson try to convince you that these returns are realistic. And now I will also say this, don't also freak out and look at the guaranteed column and think that that's going to be what happens either, because a lot of people will say that the guarantees, if they don't matter. I mean, I'm going to tell you that they're more relevant in an IUL than they are a whole life policy. But the bottom line is, chances are that the guarantees are never going to come into play, because the company is going to far outperform what the guaranteed column shows. However, you want to make sure that you can run it and see what it looks like with a 4.5% to a 5% internal rate of return, or with a cap rate between 5 and 5.5%. If you can get the numbers there and you're comfortable with what that looks like, then you can buy it and be confident and comfortable that you're going to be protected long term. And if those numbers are in alignment with what you need to accomplish, then you're in good shape. So that is that. I know this was a lot. I know this is one of the longer videos I've done on this topic, one of the more elaborate videos and comprehensive videos I've done on this topic, but I really, really think it's important for people to understand this, especially moving into this new environment that we're getting into, where increasing interest rate environments are happening. And I think what happens and the other thing I want to say here, sorry, I'm going to do this. I'm going to scrap this out here real quick. The other thing I want to say here is that with an increasing interest rate environment, this is one of the reasons I like whole life, is that as interest rates go up, whole life rates and dividends will go up, right? With IUL, as interest rates go up, what happens is markets typically suffer, right? So the IUL, not only are you going to be dealing with the options costs and the market volatility and that potentially reducing cap rates, but if markets go down, that means the performance of the actual IUL will be down as well. So the IUL will perform lower as well. So for the first time in history, we've been living in a declining interest rate environment, right? So let's look at this. So we've been living in this declining interest rate environment. So we've been, I know I said I'd be quick, but here we go. I can't help myself. So 1979, interest rates were 19%, right? And we went down to 2009 and got to zero, and we basically been over here. So now here forward, we're gonna have to go up, right? We're either gonna be flat or up. So what happens in a declining interest rate environment, so whole life policies, they underperformed constantly because dividend rates are connected to this number, right? So as the interest rates go up, and you've seen how fast they've been going up right now, as these rates go up, what's gonna happen is whole life is gonna go up with it, but IUL is gonna suffer down here. Because as this goes up and the fixed market gets better, we're gonna see negative years in the economy. We're gonna see negative years in the stock market until it resets. And then, they may come back around, but I'm telling you, looking forward here, It's a really, really pivotal and dangerous time moving forward. And what you do to position yourself, you're either going to be able to thrive from it or you're going to suffer from it. And I'm just hoping that you make the right decision to thrive. And so that is that. If you have any questions, I'm sure there are plenty of them. Comment in the comment section below. If you haven't already, if you found value in this video, please subscribe, hit the bell. That way you get notified every single time I launch a new video. Till next video, have a blessed and inspirational day. Hope you found value in this. We'll talk to you next video. Take care.